Episode of Trader Cafe. It's the 5th of December, and for those of you who are watching this live, hopefully you'll sit with me as we go through the markets for the last week. What a crazy set of markets it's been. And for those of you who are watching this tomorrow or the next day, then I hope you enjoy this, and maybe some of the things we're talking about will have actually happened, and the predictions that we try and make on this show about maybe where the market direction is going to go will have come true. Now look, folks, I think the key thing for me is it's been a crazy week. Now, we have been talking on this show over the course of the last 2 months about the need to be careful in some of these asset markets, and so it's proved. For those of you who were trading crypto over the weekend, yesterday was a pretty fundamentally poor day, I think, unless you were short and you managed to get your shorts covered in a reasonably good period of time. The market had a terrible day yesterday. Clearly a lot of liquidation going on. I know it's the weekend, but it appears to me that there were quite a few people who were out to clear their positions down and try and exit that market. Really, I guess, really sort of reinforcing what the recent price action has been. And if we get a chance, we'll go through that, and we'll have a look and see what happened around the Bitcoin and the Ethereum liquidation, just to have a quick scoot around and look at the price action both before and during, to see if there's any clues we can get for our future trading, and trying to learn something from the experience, right? Which is what we're here to do. So look, I think what I'd like to try and do today is I'm going to do two things. We'll have a quick look around the markets, but before we do that, I would like to remind everybody about something called the sentiment cycle. Now, what do I mean by that? I mean that's the market swinging from over exuberance to depression, for want of a better description. So it's the emotional mood swings of the market, which can be demonstrated by the price action that we see. Now, I believe there's a reasonably both predictable and also observable pattern to the way in which those prices move around. And as a result of that, I think you can sort of try and figure out where you are in the sentiment cycle. And if you're going to do that, that gives you a really good plan about where the future direction of prices is probably going to head. So let's have a quick look at the sentiment cycle, and we'll just let me just start my Prezzo. It's in here somewhere. Here we go. Let's pull this one up. Hopefully you guys can see this. So we'll just make this a fraction smaller. We'll just stay with the slides for the time being. Let me see if I can just kill this. Okay, there we go. As always, we have to put a disclaimer on to all of our presentations. So essentially, this is educational purposes only. And if you decide to trade, then it's your responsibility about it. I make no predictions about really what the future is going to hold. I just try and make a couple of educated guesses, which may help you out with your trading. But guys and girls, pretty much it's up to you on this one. So please, if you do anything, ignore, look at the disclaimer and make sure that you're taking account of it. It's futures trading, and some foreign exchanging is not for everybody. So really, it's just about making you feel comfortable with it. There are three key elements to any trading strategy, right? So you can't be successful without. Okay, the first thing is to select the right markets. Now, whatever system you're using, whatever methodology you're using, you've got to try and work out which markets are hot. So you need to filter. And this really is a way of filtering. So there are many different ways to filter. And we'll come on to two or three of the other ones later on. But today we're going to be looking at one section, which is the sentiment cycle. Secondly, there's market timing. Now, what do I mean by that? I mean that's when you put the trade on. Now, this is a totally quantitative decision. It shouldn't require any thought process, any second guessing from yourselves. So when you get the trade signal, you should better put it on with a risk management stop loss. And that's pretty much it. And then hopefully it makes some money, and you then move into the next phase, which is the management of the trade. And there's a reason why it's in capital letters, because it's by far and away the most important section. Now, why do I say that? Well, pretty much anybody can come up with a trading system that works eventually. If the market's going up, just buy it every day. If the market's going down, just sell it every day and put a stop loss on it. Most days, if it's going down, you're going to make money. Most days, if it's going up, you're going to make money. However, the challenge comes as to where you exit the position and what size of position you put on and how you manage the stop losses as well. So that's what I call the trade management, the position management, the money management aspect of trading. For me, that's really, really important. Now, I occasionally do webinars on this. We'll leave that for another time. Today, we're going to look at the market sentiment cycle. The sentiment cycle is part of the selection process. This gives you an idea and an opportunity to narrow down the markets that you want to trade, the methodologies you want to trade, the patterns that you want to try and look at before you pull the trigger on any particular trade. So the sentiment cycle is not new. It's been around for probably actually since the beginning of time, but there was a great analyst in the Canadian markets, a guy called Justin Mammers, who wrote about it in 1991. This is the stylized version that he put on into his book. The book is called The Nature of Risk. Recommend it to everybody. 80% of the book is quite hard work. 20% of it is pure gold. And really in that book, what he was trying to do was to identify the markets in terms of the sentiment cycle and say, where are we? Is it over enthusiasm or is it deep depression? And how do we manage the in-between bits and what are we trying to do? What you can see from this chart very clearly is there's two times when you need to be thinking about a trend. So the first one is you're moving from enthusiasm to discouragement, right? So people are over enthusiastic about the market and now they're deeply discouraged about the market and never want to trade it ever again. And the second bit is when we move from the aversion point or the higher low on a trading pattern through to returning confidence and enthusiasm. That's another trend, and it's a trend up. And when you get on one of those, you don't see those old prices at the aversion point ever again, really, not for a very, very long period of time. So really, why do we do this? Well, the most important thing about this is that if we recognize that there are two main periods of trend, so from enthusiasm down to depression or discouragement, then and vice versa from aversion to returning confidence, then we understand that we're in a trend phase. When we look at the other times, then we understand we're more than likely going to be in maybe a trend-ish phase, but more than likely in some kind of rotational phase where you can sell highs and buy lows in not quite a trading range style, but certainly in a reasonably consistent pattern. In other words, buy the dips on the way up and sell the rallies on the way down. So then you go, okay, I get that, Julian, that's all very interesting, but what Justin's managed to do is he's managed to take certain sections of this market and unpick them and say, well, what are the signs? Because there must be some signs that any market is in this space and in this, every market is in this cycle, but the question is whereabouts is it in the cycle? So let's go and have a look at some of the key things. But before we do, I just want to compare this to, that was 1991. So picture that chart in your mind of the rally, the breakout to a new highs, the failure, then we come down to new lows and then final new lows, and then we start the rally again and we have the aversion point. Compare that to the stock market 10 years later between 2000 and 2002 in the US. It's almost a carbon copy. You can see we went to a new high, we failed, we came down, 1, 2, 3. We then had the higher low formation, not quite as cute as it shows you on that sentiment cycle I showed you before. And then we start off rallying very quickly, and then we went in consolidation. For those of you that know your history, the stock market then went on to new highs, because you will notice the prices are 1,100 for the S&P and not 4,500 where we see them today. So here's another example. This is the FTSE in 2008, 2009. So you can see how the market was beginning to roll over at the top, and you have what I call the subtle warning. The subtle warning is where you begin to break a few trend lines, right? So in other words, you take your first real dip, probably through the 200-day moving average. Right, then the market tries a recovery, tries to rally back, and we'll maybe have that in your mind, because when we go and look at Bitcoin and Ethereum later on, you can see this much more clearly with those charts. And then we start the overt warning, where it starts to break major trend lines, major support areas, and then we have the panic phase. Right, the panic phase, and when there's just pure liquidation. Again, looking at stocks, you're looking at 6,500 on the FTSE, going all the way down to 4,000. Folks, that's almost a 30% decline in that particular market. Imagine what would happen if the S&P went back to 3,000 today, because that's really what we're talking about. And then you had a bounce, and then the market started to rally back, and then we had the aversion point, and so on and so forth, right? So within this, there are some key points. The first is this I'm not quite sure zone over here. And the second is this, oh my God, this is scary, buy the big dip moment over here. Those are the two things I think where people can get caught out. And you have to understand what's happening. So there are always some technical signals that are happening at the top in the enthusiasm of returning confidence phase. So when you think about the stock markets at the moment, what are those sort of signals? Well, those sort of signals would be the second liners, the second tier of stocks in the stock market. So think like the Russell 2000. How's that traded this year? Well, the answer is not very well. And in fact, it had a breakout and then completely reversed recently. If you think about what's been going on in some of the special stocks from last year, so the Netflixes, the Coinbases, the Zoom, you know, the ARK, Cathy Wood and her ARK fund, ARKK. When you look at the price action of all of those, you can see that they all topped out some time ago. So if you like, 2021 was like the transitional phase just before the subtle warning, where really the market was moving. There were things happening. People were losing confidence. But because the major stocks were still going up, then what you saw is the overall index is still trading quite well. It was only recently where you've begun to see those major index, those major shares not do quite so well, that we've begun to see the indexes themselves roll over. And that's led to, I guess you could argue, the more aggressive price action that we're seeing, especially on Fridays these days as the market sells off. We haven't got to anything like this panic or discouragement phase yet. I don't find anybody in the world who is still not bullish of stocks. Everybody I speak to is still super bullish. You know, there's nobody out there saying there's going to be a major correction, we're going to lose 30 or 40% off the stock market. There just aren't any bears around, which suggests to me that we haven't got to the panic or the discouragement phase. And folks, you know when you get there. Because when you get there, what you do is you see the headlines in the newspapers saying, oh my God, stocks are a terrible investment. How much money have we lost in ABC stock and XYZ stock? You know, do you remember when that stock was trading at 150 and now it's trading at 10? Okay, so you get all of these sort of stories and you get people turning around saying, I'm basically never going to invest in stocks ever again because it's just too risky for me. Why would I bother? I'm going to put all my money, take all my money out of stocks and put it into treasury bonds or gold or something that's much safer with a lower volatility. Now, obviously, when you see that type of negative press coming out, what you're seeing then is people turning around saying, I've had enough. Which means they've lost quite a bit of money and they're going to move the money that they have got left into something safe because they just can't take the hassle anymore. So that movement, that move out is called the discouragement phase. What it is, the market goes to new lows, and yet not all the stocks in the market are going to new lows. Some of them are starting to break out and go a little bit higher. So it's the exact opposite of what we're seeing at the moment, where you have the majority of stocks right now are trading quite poorly and a few that are trading very well. Here it's the opposite. You have at the discouragement point, the broad market is still trading relatively poorly, but there's a few stocks that start to trade really, really well. You know, if you like, picking up out of all of the selling. Those are the opportunities where we say, great, now I see that the market attitude towards this has changed. And because it's changed, I'm now going to change the view that I have. And so then you're looking for opportunities to buy. It doesn't always come up as easily, and you definitely won't be choosing the bottom of the market. But what you will be choosing, hopefully, is a reasonably safe place that won't lose you too much money if things go wrong. But secondly, gives you the opportunity to participate in what is essentially the sentiment cycle as the market swings around, gains more confidence, starts to move back to that enthusiasm point, and eventually it moves back to the crazy enthusiasm that we have at the time. You know, I think the amount of inflows into US stocks this year are something in the order of 900 billion, which I believe is the last 19 years total more than the last 19 years total. So it's an extraordinary movement of retail investors into the stock market. Now, when that normally tends to happen, it's accompanied by some kind of market top. We can't time it. We just know that there's something wrong. And when retail starts to get that enthusiastic, we go, oh, okay. So let's go and look at some of these areas in a little bit more detail. So during the returning to confidence phase, what is going on? People have been hurt before, and they're being forced slowly but surely and reluctantly to get reinvested again. So they don't have much confidence, but what they're doing is they're saying, I don't really want to miss out on this. So and there aren't any other good investments around. Oh, I'll stick some money into stocks and see how we get on. And they will usually in those situations get rewarded. So that return to confidence phase, you see people being a little skeptical, and the headlines will be skeptical, but overall the market trades okay, right? And that's the key thing. It's like that's what's been happening is the rally's been going on. People are feeling more confident. They're ready to invest. They're doing they're doing bits and pieces, but they're not excited. They're not excited, but what happens is, and this is how you can tell, you get these buy the big dip moments, right? Now the big dip moments could be 5%, they could be 10%, but you'll see the market trade off and then hesitate, maybe at the 200-day moving average or the 50-day moving average, and then it'll bounce and return to higher levels, right? So really what this is just proving to you that every time the market dips, it's time to buy. Now that's a pattern that we see quite regularly in a lot of markets, and those of you that trade the cryptocurrencies will hear and see people talking about, oh, it's going down, just another opportunity to buy it, right? So very important to understand that from a sentiment point of view about where we've got to. And really, I think one of the key elements of this is this buying the big dip, right? So this move down to a 200-day moving average, the move down to, sometimes the 50-week average, but usually 200-day is the really good one. That will be the scary one because the market will go down, it will touch it and then bounce very quickly off it if you're talking about equity markets. So you tend to see this pattern repeat itself quite a lot. And on the way up, as happens for those of you that trade some of the cryptocurrencies, you'll see this. There'll be a 10% retracement. The market will then bounce really solidly and go to a new high from there. So then what happens is, because each time the market bounces from those low levels, people get emboldened with more and more and more confidence. And then you start to enter a second phase. The second phase is where it starts to get interesting. As we would probably have experienced this year with all that retail investment coming into the market. What you're seeing now and in this particular stage is what I call the fear of missing out stage. So people have moved from the fear of losing money to the fear of missing out. There's huge FOMO. They hear all their friends down the golf club or wherever they happen to meet, the working club, are making all this money out of stocks or cryptos or NFTs and all this stuff. And they go, great, I want a piece of that. So they move past the point at which they're saying, I might lose my money, to the point where they're saying, I've got to get in. And that's really a hyper enthusiastic stage, right? So, and in this instance, you can see the photo, pretty much everybody is on board, right? So when you look at this on the chart, this enthusiasm, and normally from a technical perspective, is encompassed by a significant breakout from a trading range. So this is the breakout to new highs. Again, we've been seeing that this year. What happens at some point, though, is the market breaks out to new highs, and rather than going on and going off the end of this slide to the top side, the market actually rotates and comes back again. So in other words, we've got so high that we just run out of buyers. There's always sellers around, but we've just run out of buyers. And so the market then comes back to try and find the buyer. Now it does it by coming back to some of those short-term moving averages, not the 200-day, the short-term moving average. It's like the 50-day moving average. We'll come back and find out if that represents major support. If it does, then great, the market will bounce there, maybe goes on to new highs. If it doesn't, it'll give it a couple of goes and then it'll finally break through. So when it starts to break through, that's what I call the subtle warning phase. Okay, at that point in time, people are now saying, uh-oh, there's something wrong. It shouldn't be doing this, hasn't done this recently. When you hit the over warning, that is like breaking the 200-day moving average and getting a close below it, right? So it's some aggressive selling being put in place by some of the market participants. And at that stage, we know that a new bear market, in this instance, a bear market, is taking place. Okay, as that bear market takes place, it takes time to unfold. It never normally goes in 1 or 2 waves. It normally takes 3 waves. Maybe not so in foreign exchange. Maybe in foreign exchange it could be 2, but in this market, in most of the equity markets, it's usually 3. Now, why is that? Well, the first time down, where you have the bulk of the collapse, is called the panic phase. That's people doing exactly what it says on the tin. They're panicking. They're saying, I cannot lose all of my gains. I've got to get out of this, and I'll come back to it another time. But for the time being, I'm locking it in. Then you move. The market bounces off that panic point, and then it starts down again and then breaks to new lows. That's the discouragement phase. So what's happening there is people are saying, this is it. I never want to see a stock market like this ever again. I'm never investing in stocks. I've lost so much money. I can't believe I'm doing this. Okay, and at that point, the downtrend is over. Not over for every stock, but it's over for the market as a whole. Individual stocks within the market will probably trade quite poorly. So a piece of news will come out and the market will go down, but there'll be some stocks where even bad news prevents the market, or bad news is still, the market is still not falling when it's presented with bad news. Okay, so if you think that any particular company has some really bad numbers, but the market just doesn't go down, the stock just holds in and is quite resilient. Well, this is where you've now got some of the smart money, the value players coming in here, looking at the stock saying, we think it's got cheap enough now, and we're happy to buy it. So then you start to climb the wall of worry. Okay, so we've covered these 2, and we got to this one. Yeah, so during this phase, the discouragement phase, pretty much everybody thinks the market has gone down. Now, some people are incredibly accurate at forecasting this, most notably the BBC and some of the financial press as well too. The reason why they're so good at forecasting is by the time it gets to the mainstream media, the correction is probably most likely done. So you don't hear anything about how bad the stock market is doing until you get to these type of points, when everybody says, oh my God, that's it. I'm never going to invest anything in this. I'm moving my pension to bonds, and I'm never going to go anywhere near stocks again, right? So, but like I said, what happens is the news is pretty horrible, but the stocks don't trade as badly as they have been, which is a sign that things are bottoming out. So as you climb the wall of worry, there's all sorts of people that start to get involved, right? You have the people who are trading bottom feeders or value guys. You have the bargain hunters. You have the momentum players who start to see the market trade a little bit better. And also the performance chasers as well too. So as we climb the wall of worry, what's going on here is where the smart money is accumulating positions, right? So every little mini dip is bought again, and you're putting in higher lows all the time on the chart. So there's really have been at this stage no sellers left to sell in the market. So the buyers who are around just come in and are able to lift prices a little bit higher, right? So it's sort of that all adds into the slightly more positive state of the market. So then you go from the point at which the market sells off again. So it's been rallying for a little while off that discouragement point, and then it sets back again. Something will go wrong. There'll be some news will come out, or the wrong time of year, whatever it is, from a seasonal perspective. All of a sudden the market will trade back, and in trading back, in retracing, what then happens is everybody will tell you, oh, I told you so. I told you this market was rubbish, but it won't set a new low. Okay, it will set a higher low, and at that point you get what I call the strongest buy signal in the market in the whole sentiment cycle, because when it moves, it's incredibly fast. And we'll look at a couple of examples here. It's incredibly fast. It never comes back. And so this is why with this particular thing, the aversion point is so critically important. And during that point in time, everybody will be telling you not to buy stocks. As the market's rising, they'll be saying, oh yeah, don't mind it. It'll come down again. Now, you know better. But this is sometimes where you need to do your own analysis rather than look at what other people are saying. So at this aversion point here through to denial, this is incredibly fast as a movement, right? We'll come back to that in a minute. And then finally, we get back into the returning confidence phase, and we start to see the market behaving the way it should do. You know, the retracements in the trend are, you know, they are increasingly large, but they're very shallow, and it gives plenty of opportunity for you to be for people to participate, right? So let's go and see if we can find a aversion point trade that I can just show to you guys to see what we're talking about. This is a classic one here. So this is an Aussie sterling. This is foreign exchange rate. Here you can see the returning confidence, the enthusiasm, then we fail at the top, and then we start the bear market. You can see the trend lines here. You better draw a trend line through there. You better draw a trend line through there for your subtle and your over warnings. And then finally, as it breaks the major support line here and then starts the downward leg. Here's the panic. Here's the discouragement. And here's a classic example of the aversion point. Now look at what happened here. Look at the speed with which the market rallied. You will not see these prices for some period of time. And if you look at it, that's 48 cents on the Aussie. You know, just imagining where it is now, we're nowhere near those levels, right? And I don't think we ever went back to have a look at them. So really, when you're thinking about this, and this comes from Justin Mamas's book, there's one key part. So two things to bear in mind. Number one is that there are two times when the market trends. So that time when the market trends is on the way down, and secondly, when it's on the way up. So that aversion point through to returning confidence phase, and on the downside, it's a subtle over warning through to discouragement phase. So when you actually unpick what some of these chart patterns are like, I want to just get you to focus in your mind on this. And you can see how the market is coming down, sets a low at A, rallies back to B, can't really hold it, goes back down to retest again, rallies back up to another B point here, and then finally at C it collapses, right? So the B's are where there's like you have these failing bounces, and then the final collapse down to C. Everything is negative. Okay, so if you like, there's very little price risk at that point because we got to the point where things are quite cheap, but there is complete information risk in the sense that any piece of news that comes out seems to hit the market very hard. We then see this move up to D, where we have the denial of all the positives, and then on our way backwards slowly to the aversion point at point E. From that point onwards, it never looks back. When it turns the point there, it turns the corner there, it never looks back. So now, with this in mind, why don't we try and have a look at a couple of charts and see where we're at today? And I'm going to highlight two or three, so just bear with me for a second. And again, guys, if you've got any questions at all, just ask away, right, while we're doing this. Let me just share my whole screen here. Might be better to share the screen, then you can all see it. Let's start off with Bitcoin. Let's go to Bitcoin. And let's look at what we're seeing on a 4-hourly chart, for instance, see if we can see anything in it. Now, when we look at Bitcoin, going back through time, let's go back to the dailies. I might just work off the dailies, I think, for the time being. So if we go back and we look through time, right, we just squeeze this out a little bit more to make it more melodramatic. So you can see here that we had, here's the returning confidence. We had a brand new high. We had a failure. We came down. We took out some minor supports. We went back up again. Then we took out major support. Then we hit a discouragement phase. You remember that back in June and July, guys, where Bitcoin was just could not go up. Everything they did was wrong. Okay, and then it began its decline. So we had the final low there, and then we had a higher low here. So it tried to retest it and then failed and then started to go back up. You can see the speed at which it went back up. Then we had our ABC buy the big dip moment, and look at what happened next. It just exploded to the top side. So when we go back to look at those sentiment cycle charts and we look at that major bottom and how it starts to form, right? See the initial low, the bounce, couple of bounces down to a final low, and then we have a bounce, and then we have a higher low formation put in place. So that's really what we're looking for. And you can see, look, life isn't perfect, but you can see that between this low here and this low here, you had a higher low put in place. You know, lovely if it would have been up here, but it wasn't. You still got that test and that shoot off. It literally a huge bounce. This is a daily chart. We had like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days up in a row, right? And then the market kept going and going and going. Then it had its correction. So A, B, C correction. And then we got to the buy the big dip moment, or the real aversion point, or whatever point you'd like to have it. I'm going with buy the big dip, and then the market just literally took off again up to, in fact, the 68,000. Okay, so we went up, we had a look, we sat down, we consolidated, range traded for a while, but still at the very high levels. Then we took out the new high. And then what happened after that? The market then immediately fell and had a false breakout. The top side began to fall. So your subtle warning, you had a trend line there or a trend support here. Both of those were broken. Overt warning was here when we started to break through major support in this area. Went down, and then we had 2 or 3 days where it just kept on making new lows and then bouncing, but not bouncing really convincingly. And then over the weekend, Friday and the weekend, we had the big sell-off, right? And I don't think we're finished with this yet. Now, for those of you that are looking at the sentiment cycle, I don't think this is a buy the big dip moment. For those of you who are really looking at this, you can see the pattern of the rejected highs. You can see the breakdown. It appears to me when I study this chart, we've got a little bit further to go, or we've got time to go, right? So what's got to happen is time has to elapse. And we've got to think about the fact that maybe that the time isn't working for us. So when we're looking at this, time isn't working for us. What I mean by that is time's got to pass where the market volatility collapses, so the price action just squeezes down. Apologies, a little late on a Sunday evening. So when you go down a time frame, we look at the 4-hourly chart, we can see that big capitulation move, and we can then see the bounce consequent to that. So what do you think is going to happen next? It'd be a fair guess that we're probably going to fluctuate somewhere between, can I draw my squares? Oh, we tried this last weekend, didn't we? Here we go, rectangle. So we're going to settle somewhere between here and here. The market should start to go up into this box, major resistance. You can see it's already running out of momentum. It should turn here. So look for a new little mini spike up and then a collapse, or else we just move down again. And what will happen then is we'll see if this really was the low for Bitcoin. If we go down, and we're going to go down below the 41,000 mark and head to a new low. Now, for those of you that are following the sentiment cycle like we would turn around and say, well, hang on, that just looks like the panic phase. We've got a little bit further to go with this, haven't we, through to discouragement before it starts to rally again. Sometimes I know cryptocurrencies, their time frames are really compressed, but I think what you've got here is to recognize that we've only had one wave here, and there's maybe other waves to come. So we'll see what happens. Let's take a look at Ethereum and see how that's doing. Again, it had a significant fall on Saturday, and on the 4-hourly chart, it has started to bounce again. So, but we're hitting major resistance right here, right now. Okay, and I think that's really critical. This area here is major resistance. So around this area, we'd expect the market to make its mind up, right? So making its mind up means it's going to go down, try and find that higher low, have a retest of that liquidation bottom that we saw put in place, and liquidation low. And then we'll see whether it's going to rally or not. In the meantime, it's almost like, well, the market's trading down. Maybe you should think about just selling that because it's bounced, right? So this may be a selling area. Okay, let's move on to talk about oil, because I think oil is very interesting in terms of the way the price action is working. Almost completely different. It's had a little bit of time. So let's start from the daily. And we'll just unpick the daily fraction right now. Within this daily, if you go back and look, you can see where we had a failure up here. So we had a failure up here. Somewhere in here is a subtle warning, probably roughly along this line here. And we had we probably had an overt warning when we broke. Let's just squeeze this up a little bit to make sure we're doing it right. Yep, so here. So when we did this level here, that to me was a pretty key level, but certainly you can understand, why we did this, and then I'll move this to there. Lots of highs and lows. including closing prices, you can see how that would be the over break point, right? And then we started to move down. Now, the question is, on the move down, the visibility is, you sort of see it, but I can make it out. Some of you might not be able to make it out in terms of sentiment cycle. So let's break it down for ourselves, right? Let's break it down. So here's the downtrend. Then we've had the panic phase, right? You can see how we panicked down to 67. And if you remember going back 2 or 3 days last week when that happened, or the week before when that happened, that was actually quite reasonable. There was a lot of liquidations going through at the time. Then we've had a bounce, and now we've gone on to new lows. Then we've had a bounce, we got on to new lows again. Now, if you think about what the headlines are today versus what the headlines were a month ago, oil's going to $150. It's amazing, it's amazing, it's brilliant. Now it's, oh my God, we've lost all of the backwardation on this market. In other words, the front contracts are more expensive than the further out 1 year, 2 year contracts. All of that's gone. It's disappeared, right? There's no shortage of oil. It looks to me like there's a real oil glut at the moment. Remarkable how you can have that in 3 weeks, but we'll say there is. There's a real glut. Nobody wants to buy this thing. Everybody will be saying, oh yeah, I want to wait till I see some better price action before I buy it, type of thing, right? However, what we've noticed is there's 3 waves in here. There's wave 1, wave 2, wave 3. This put a significant tail pattern buy signal in as well too, and this here on the price action on Friday looks to me like we're heading into a short-term aversion point. Now, what the good news about this is if you're wrong, you've only got to risk a small amount. So you're only actually risking this difference here, right? Or wherever the open happens to be. So you're probably only risking a couple of dollars to maybe get back and start a new trend where the market trades significantly higher up to this area. So this area up here. So what we're trying to do here is we're trying to put our risk reward on to make sense for us. So when we look at this oil chart, we can see the 1, 2, 3 pattern that I like. I know it's only 4 hours, so it's a very truncated piece, short period of time, and maybe it won't hold for any length of time. But I could easily see us bouncing here and heading on back to 75 in the oil market. The question is, I don't know how long that's going to take. One would assume if we're trading a 4 hourly chart, there will be a ring low or some sort of formation in the next few days that will give you the opportunity to get involved. So this is a little, not prediction, but I'm just saying here's what I'm seeing in the charts. I'm seeing this type of aggressive buying price action come in at the bottom of a sentiment cycle move, which suggests to me that the market for the short term, the falls might be over. Okay, so for the short term, it might be over. Okay, let's go and have another look at some of our old friends here. Let's go and have a look at the guys from Tesla and see what their chart looks like. Now, here you can see the returning confidence. Tesla's obviously worth $1 trillion. Of course it is. You know, it's an amazing company, worth more than the whole of the car industry put together. Obviously, why not? We then had the market starting to come off. Okay, now that starting to come off is actually a correction of almost 15%, but bear with. Right, okay, so then we've established this trading range, and then the last 3 days we sold off significantly. So for me, what I'm looking for here is this major support to hold, right? This absolutely leveled down here. We can't see the market trade through it. It needs to hold that level. Closing below that would be very bad. So unless there's a very quick reversal when it does, it's with this gap down here is very threatening. That this gap here is very threatening, and that's down at 980 and 900. So we'd probably expect Tesla to head down towards there for its for a corrective move anyway, to then see what happens next. But you can see when you look at this chart does not look like the oil chart. It appears there's something else going on. It appears it's not finished yet. Okay, so the trend looks like it's got a little bit further to go. Now, in the world of on the other hand, we have gold. Now, as we know that when we looked at gold the other day, the gold was breaking above the major trend line here, the major trend line support here, or major resistance, I mean here. It broke above it for a few days and then collapsed back below. And we're sitting down here. Again, we've got significant trend lines coming through the market. You know, we can see how that would affect the price of gold, and we're sitting on that trend line. We're also sitting on a horizontal trend line that runs from here like all the way through this market. This is such a critical level, the 1760 level. It goes not just this way, but it also goes this way too. So 1760 is an enormous market support area. We start to get significant closes below that. I think gold may be in trouble. So let's just go and have a look again at the shorter time frame, see if there's anything we can gather from this. I'll just try and get rid of a couple of these charts, the trend lines. Okay, there we go. So how does this look on the sentiment cycle? We're looking at a 4-hourly chart here. So you can see, here we go, often new highs, tried to retest, failed, tried to retest again, failed, then bang. Then it starts to go down and go down and go down. So this is the first big move, and then we've gone for a second breakout. We went up and then we went back down again, bouncing, and now we've gone down to a new low at 1760, right to that trend line. Now the question we've got is do we think that this is it being over for gold? And I think it's a very fair point. I think we clear that 1760, excuse me, we clear the 1760 to the downside, and I think really we could be seeing some major resistance. Crikey, guys, really sorry, I'm not with it today, I'm a little sleepy this weekend. We could see some major support levels broken out. So for me, 1760 is critical. We get below that, I think we're in trouble. Above that, I think gold is a great buy. We should hang with it. And the reason why I think gold is a great buy is I think it's a great inflation hedge. I also think it's a great hedge against the stock market volatility as well too. Where are people going to go, right, if they want to get out of stocks? What do you buy? Because trying to buy crypto doesn't make any sense, and there's a reason why that doesn't make any sense. It's because it's more volatile than some of the stocks are. So what you want to do is to go towards safety. Well, who wants to own a treasury bond that yields you 1.25%? You might as well go and buy some gold bars or some gold that doesn't yield you that 1.5%, but has got a chance of real price appreciation over the course of the next 2 or 3 years. So I remain core bullish on my fundamental gold view, unless we break significantly below 1760, at which point I'll be tempted to throw in the towel. But for the time being, I quite like gold. All that's happening is we've just come down to a major support level. If we hold it, then we're looking good for another bounce. Okay, now some of the currencies. Let's go and have a quick look at some of those and see what's happening. When we look at the Aussie dollar, gosh, this has been a difficult one to call. So again, you see the returning confidence. He went to a new high. We broke back down again very quickly and then broke back down aggressively very quickly. That was your first sign that there was something wrong. So this move up to 80 cents was pretty much overdone. The markets then come back down. Then it tried again to break out here and then failed again. So how many times you need to be told this, right? There's your first failure. There is your second failure. Okay, and then we started the big decline. We had a move here that bounced. We then did nothing, where there was no follow through at all. And as a result of that, sorry guys, as a result of that, there was no bounce higher. So then it was only a matter of time before the market went, oh, well, maybe we ought to go down then, and then down it did. So we've had one wave, then we've had second wave, then we've had a third wave, then we big bounce. Come back for a higher low, really powerful move off it. So everything was looking great. It was looking constructive. And then boom, we've gone into another wave down. So this doesn't look that good to me. And when I look at it on a weekly chart, there appears to be, right, a significant move afoot here, right? So we got literally sitting on the major support at 70. I would expect this time around, we're going to go a little bit lower because we've had 1, 2, 3, 4, 5 weeks straight down. I'd expect it to go a little lower, as the commodity currencies are apt to do at the moment, because they're taking all the heat, because commodity prices are starting to come down, and then maybe put some kind of a bottom in place down there, or else we are in fact heading back down to new lows, which is amazing, because I don't believe the Aussie deserves that, quite frankly. I think it's a much better currency than that. Quick look around the dollar CAD. What more can we say? There's your buy point, there's your aversion points, discouragement, aversion, and we're 5-6 weeks up. Easy. Okay, guys, this is the weekly chart of the Japanese yen. I can't make head nor tail of this. Is it topping out here? Maybe. Is the Japanese yen due to rally? Maybe. See if we can find anything on the dailies to give us any more clues. Well, we did have that big breakout to the top side that got completely whacked almost straight away afterwards. That may be something, and perhaps that in that case the dollar yen is going to weaken further as the yen strengthens. And finally, we just have a quick look at the euro. And again, as far as we're concerned, the euro has been coming down for quite some time. But, and here's the but, it doesn't trade at the moment like a market that appears to be cheap. It trades like a market that's struggling to rally, struggling to find itself, and maybe it's not looking as good as we think it is. So I'd be very cautious on this at the moment. I'm finding it very hard to trade some of the currencies. If you look at the last 2 weeks, they've been really crazy all over the place, and you're pretty much trading stocks. So you're actually probably better off just trading the underlying stocks itself. Okay, folks. I don't think I've got, well, actually I've just seen the time. We've got a few minutes before we go on to the weekly macro report. So I'm going to take a breather for a few minutes. If there are any more questions, I'll just give everybody a couple of seconds to put some questions up. I see somebody would like to have a look at the Nasdaq. Let's go and have a look at the Nasdaq. Okay. Okay, so guys, this is the daily chart. You know, what do you, I'm so listen, that's a big move, right? We've gone from what, 8,000 to 16,000. We've gone up 50% in the course of the year since the low in the pandemic. What would happen if we lost 30% off this? Would anybody even notice? It went from 16 to 12. Would anybody actually notice that? Would that even break the low of the year? You know, the low of the year in 2021 was back in March at 12,000. We've got to go below 12,000. Sorry, guys, I apologize. Thank you very much for saying you can't see the screen. I'll put this back up again. Hopefully you've got this. So the low of the year on the Nasdaq is down here at 12,000. We're currently at 15,000. So when you say to me, is the Nasdaq move down over? The short answer I've got is how many times you need to keep going for new highs, which is lots and lots and lots and lots and lots on this chart. At some point in time, we're going to fail, and we're going to fail more than the 5% that we failed in the past, right? Because at some point in time, they've got to take everybody out to the woodshed and convince them that maybe buying stocks isn't such a great idea. So in my mind, we have a little bit further room to go on this. How are we going to do it? I do not know. Where are we going to go to? I don't know. Pick a major support, 14,000, right? Pick another major support, 12,000. Okay, back into this area is major support. What I do know is if the market started to trade like that, that would lead to a lot more panic selling. So, you know, let's stick with our sentiment cycle moves. The daily chart's just as good. Okay, so we've had the break to new highs, we've had the rejection, we've had the rally back, that's rejected too. What do we now expect? Well, we may consolidate for a couple of days, and in that consolidation, we'll watch what happens to price action. If it stays flat, right, then it's probably going to go lower. If it bounces aggressively and bounces above the high of Friday, it's probably fine. If it just keeps going down, well, it keeps going down, right? And we know then it's pretty obvious what we need to do. Just to recap quickly on gold, 1760 is a short answer, Zach, about where gold's got to go to. It's got to stay above 1760. Above it, I'm bullish. Below it, I've got question marks. That's the pattern on gold. If Ainsley's on the show tonight, then she'll be able to talk about that a little bit more. Guys, I'm really sorry we've run out of time. I hope you found that interesting. Just doing a quick macro recap. My overall conviction, Fabian, is that right now I believe right now that the equity market is going to struggle for some time. We are at a super sentiment cycle high here, and I don't know, for whatever reason or whatever the cause is going to be, I'm pretty sure that we're going to struggle a little bit on the equity side for the next 6 to 12 months. That doesn't mean to say there won't be great times to buy. There will be. But I think the time when you just buy it, hold it, forget about it is probably over. From here on in, for the next 18 months, you're trading stocks, you're not investing in them. Okay, folks, I hope that really helps. And as always, be careful out there. And if you have been, thank you very much for listening. And I'll see